What's up, guys? Welcome back to DCA. So what I want to do in this video is talk about how we value Bitcoin. So we're going to be looking at the Bitcoin active addresses, but we're going to think about it in a slightly different way than we often hear about it. So what we have here is the Bitcoin active addresses, and we're looking all the way back to 2012 here. And you can see that Bitcoin and the number of users using the network daily has essentially been doing nothing but increasing all the way back from 2012. There have been points where the number of daily active addresses has retracted, like we saw back here in 2017 into early 2018. And then like we saw here in April into essentially June and July of 2021. Now, these often correspond with the bull and bear market phases. So we're going to look at this today, and we're going to analyze the way that Bitcoin is valued based on this. And I'm going to show you how everything that we're seeing in terms of participation in the market, in terms of conviction in the asset, how it's only strengthened over the years. And why, for these reasons, that I think that, in spite of the fact that we're far off from all-time highs in terms of price, like we've seen in every single market cycle, I think there's still reason to believe in the asset and to not lose your own personal conviction. And I'm going to show you why that is today. So what we have here is on the top, the Bitcoin active addresses, like we've said, the daily active addresses. And below this is a metric which shows us how far Bitcoin active addresses are from their prior all-time high. So when we're at 0, that means we're at an all-time high. When it's all the way up here, when there's very little color underneath of it, that means we're right at or near an all-time high. And when you have these large pullbacks, that means we've hit an all-time high like we saw here, which is why it's at 0. And then you see a massive drawdown, all right? So that means that at that time, back in this peak here, when we were at around 1.3 million daily active addresses here at the end of 2017, we then saw that price crash. So in October, November, and into December, we just saw a huge number of participants FOMO into the market. So Bitcoin went from a price of around $4,000 to $5,000 all the way up to nearly $20,000 from October all the way to the middle of December of 2017. And you see that, the number of daily active addresses just absolutely spiked during that time. So, during that phase of the market, we were at a pretty consistent 700,000 daily active addresses. And you saw that spike all the way up to 1.3 million active addresses. So nearly doubling of the daily active addresses in a time period of about 2.5 months. And so that's why we had that bubble formation at that time, because you had a huge quantity of capital coming in, FOMOing into the market, and right after that, we all know what happened. There was a huge crash. So the price crashed, and then all of those people sort of left the market. And that sort of damaged the network for some time. So you see that, we were pretty consistently moving from 400, 500, 600, 700K active daily addresses. And then it, went all the way down here to around 560,000 daily active addresses. So in a very short amount of time, we see this huge correction. So we went from a place of pretty much nothing but growth all the way from 2011 into 2012, straight through the end of 2017. And then you see here, indicated by this deep blue color, we had an extended period of time where we were consistently far below this peak or even a prior average of daily active addresses. So we sort of lived in this 400 up to around 600,000 daily active address range all through the middle of 2018 and into the early stages of 2019. Then you can see, based on this here, that we started to recover. Okay, so we were recovering, and then we finally started to make new all-time highs out here towards the market cycle peak of 2021. So one thing sort of jumps out on this chart, and we're not going to spend too much time talking about this here, but what you see right now compared to what we saw back in 2018. So in terms of the drawdown from the all-time high, we've only seen a drawdown of around 22%. So there are still a lot of daily participants in the Bitcoin network, all right? And we saw that, this is dissimilar to the 2018 cycle because we had a massive correction in terms of the daily active addresses. And we haven't seen anything even close to that in this cycle. There was a very short amount of time where we saw a significant correction back here in July of 2021, back in that initial crash after, the Tesla announcement, after the China announcement, those sort of confluence of negative events that were occurring. We did see this big correction, but it rapidly recovered. All right. It recovered into November essentially. And we've more or less been sitting around the November participants in this market, even here as we're sitting at around $20,000. So we've seen this giant price correction where we went from 69K all the way to, between 18 to 19 to 20K where we're sitting at right now. And in spite of that, we're still seeing a huge number of active daily addresses. So you're still seeing that people are participating in the market. All right. Now, that's one thing to consider. That's definitely one thing to consider, but it's not the end all be all. So we're going to take a look at some additional metrics here. So, just to sort of look at what we just looked at, but think about it in a more broader sense now. Because, these daily active addresses where we're hitting spikes up to 1.3K, but it's just, this was very short lived. This is maybe 10 or 15 days where we were up at these 1 million plus levels. And in this cycle, what you've seen is a much higher consistent level of daily participants. And that's ultimately what matters. These daily spikes don't matter. And why is that? Well, we often think about Bitcoin in terms of its all-time high price, but really that's a ridiculous way to think about what the price of Bitcoin is or what the value of Bitcoin is. Because Bitcoin is not, if you care about this as a long-term investment, it's not really, these short-term spikes are probably less relevant to the actual value of Bitcoin than any other sort of point in time in terms of the price. Because you have to imagine, when we have these bull markets, when these bull markets come, how many participants in the cryptocurrency asset class sort of come in right during this time that, ultimately have no intention of sticking around. They have no intention of using the asset. They have no intention of, continuing to invest in the asset. They are only coming in at the last second to drive the price up to these ridiculous values where we hit a bubble, the bubble pops, we correct, and then we have to start all over again. So based on that, looking at the networks like this and thinking about, 20K back in 2018, well, that's what Bitcoin should be worth. 69K in November of 2021, that's what Bitcoin should be worth. And quite frankly, that's not what Bitcoin should be worth. Now, obviously, the 69K was not associated with one of these giant spikes in daily active addresses. So it was a bit dissimilar in that case. But, the 64K or 63.5K example of April of 2021 is a much better viewpoint of that, where we had a large number of people come in that aren't really anything but speculative investors. They're not intending to continue investing in the asset. And so they drive the price up to unsustainable levels, essentially. And so, that's why I maintain that because of that, that is not an optimal way to think about what the value of the network is. So what is the solution to that? And let's take a look at this. So this is a moving average, a 365-day moving average of the active addresses. So you can see that, basically from 2011 through the beginning of 2018, we saw nothing but rising values for the daily active addresses. So this gives us a much more clear picture, what type of activity is actually occurring on the network. And it does that because of the fact that, we're looking over a broad range of time here. We're looking at bullish segments of the market. We're looking at bearish segments of the market. We're looking at everything here, not just these rapid increases that happen in a very short amount of time with people that aren't actual participants in the network. They're basically visitors. They're coming by. They have no intention of using the network. They're in and they're out. So this metric sort of gives us a much better picture of that then. And what we see is that, in 2015, we hit 250,000 daily active addresses. Then in late 2016, we hit around 500K. Then in late 2017, we finally got up to around 750,000. And then we hit a bear market. And when we hit these bear markets, we're always going to see correction. Even in the future, once things have become much more sustainable, I think you're going to see sort of drawdowns when we head into bear markets. All right. So when it's deep red like this, that means that we're constantly hitting an all-time high. When it becomes purple down into these bluer ranges, these are retractions in the number of daily active addresses. And so you saw a severe correction from 2018, basically through around here of March of 2019, more or less coinciding with the bottom of the market cycle. And so what was that correction? Well, we saw that over a 1-year period, there was actually about a 20% drawdown in the amount of daily active addresses. So this really works to smooth out like these points right here. And these more, massive corrections like we saw here where we were down about 50% from the all-time high. So this is a much better way to look at this, in my opinion. And what we see is, we hit this trough, and kind of once we started to head back up, that was it. The price of Bitcoin never got back this low again, as we saw in January, February, and March of 2019. And we headed into a more bullish segment of the market. And you saw that manifest itself as growing active participation in the network. If we look at, the more bearish segment of the market back in 2019, we were down to around 600,000 daily active addresses. And if you look at where we're at now, even in this bearish segment of the market, we've gone from a peak of around 1.04 million active addresses, and we've only gone down to around 915,000. All right. And so that means this network has maintained significant participation in spite of the fact that, we've had this extreme bear market, and this bear market has been extreme so far. And we'll talk about in a moment why, very likely why things appear so bad right now. So we've seen this massive correction. Back then we went from around 800K at its peak down to around 620K. So the correction back then was larger, both in terms of absolute terms, because we went from around 800 all the way down to around 615 or so. So about a loss of 185,000 daily active addresses over an entire year's worth of data. And in this cycle, we've only seen this fall about 100,000, all right? And less so in percent. So it's only fallen about 10% or so compared to the about 20% drop that we saw back here in 2019. Okay, so what we can do then is, with all of this data that we've collected, is say, well, how does all of this relate to the actual value of Bitcoin? And then this is going to be the important part here. And what we can see is, this is the price of Bitcoin divided by the daily active addresses, okay? And this gives us a framework by which to think about the value of Bitcoin per active address. And so one thing we need to consider is something called Metcalfe's law. If you're not familiar with what Metcalfe's law is, this essentially says that the value of any given network is going to be proportional to the square of the number of nodes. All right. And let's think about this in terms of an analogy. If you have a cell phone, but you're the only one on Earth with a cell phone, and we're going to exclude landlines here. So you have a cell phone and it's this great technology and you want to use it to call your friends and tell them about it. But guess what? You're the only one with a cell phone. What's the value of that cell phone? Well, in and of itself, the technology itself might be valuable, but in and of itself, that actual cell phone carries very little value with it because there's no one to call. Now, if you add someone to the network, so now there's going to be two of you, that cell phone, it gains exponential value. Now, what if you add someone and then another person and then so on and so forth? You're adding additional people. The more people that you add onto that network, the network becomes exponentially more valuable. And Bitcoin operates very similar in this regard. And there's actually been a lot of work done in this area that has shown that, Metcalfe's law, it's a good mental framework. although in practice it doesn't exactly live up to sort of the calculation as it's proposed. The work that has been done out there with regards to Bitcoin actually does show us that there is something to this, and that as we add additional users to the Bitcoin network, there is some exponential value being added to the network. So what we see is that over time, Bitcoin has sort of followed this general pattern here. Okay, so we see that the price hits these peaks up here, like in 2013, 2017, and 2021. And then after the panic selling occurs, we then hit these troughs at the bottoms of the market. So 2012, like we saw from 2015 through 2016, like we saw here in 2018, parts of 2020, and 2019. You know, these are more bearish segments of the market. So these are times when the network becomes undervalued. And then there are these shorter segments of the market where the network becomes wildly overvalued. Okay. And so I think that, you know, it's important to note then, well, where are we right now? And you can see that we are at the moment kind of down at this level where the market is usually at its, you know, more or less its bottoming out point. And remember, we're talking here about the value of the network per active address, not based on the price strictly. Okay, so this fraction is price over active addresses. So what that means is the price is going up in isolation, for instance, the value per active address will be going up. But if the price stays the same, but the active addresses start to fall, then again, the value per active address is increasing. So what we see though empirically is that there's a direct correlation in the long run with price and the number of active addresses. So during times when active addresses are increasing, we actually tend to see that the price increases faster than the active addresses, and it also falls faster than the active addresses. So in other words, a percentage change in active address leads to a larger percentage change in the price, both in the up and the down direction. And what I've done here is shown the average value of the active addresses and the average value of the price per active address over these market cycles. And we can see that back in 2013, you know, the active addresses on average, so we don't care about the peak, we don't care about the bottom, we're just looking at the whole picture, was about 100,000 daily active addresses. And that gave us a value of around $0.0016, or around 0.2 of a cent per active address. So each individual on the network contributed approximately 0.2 of a cent per each Bitcoin. Now, in 2017, we saw that then increase significantly, going up to around, you know, 0.0099. So almost exactly 1 cent per active address. And we saw that the active addresses themselves on average, so we're talking about bullish phases of the market, the bearish phases of the market, we're talking about, you know, a wide range of time here. It went up to around 562,000 active addresses. And then in 2021, we've actually increased to around 872,000 active addresses so far. Now remember, daily, we're sitting at around 900,000 plus active addresses right now. So on average, this is increasing over time. But I think this really goes to show something. And that's, you know, if we look at the price per active address, like we expect, you know, according to, if we just take a look at this quickly again, Metcalfe's law, remember that as you start to add more and more individuals onto the network, the average value of the network increases by some exponent. And that's exactly what we're seeing here. So we haven't quite doubled in terms of the number of active addresses yet, but we've seen the value of Bitcoin on average go up around 4.5 times that of the prior market cycle. So we're continuing to see the network grow in terms of active users. So that, you know, gives us a sort of a framework by which to think about where the price is now and why this, you know, this change in price where we went from around 69K all the way down to around 20K, why it's so severe, and we can then think about what it means. Recall that, you know, the number of participants in the market, as we saw this 83% drawdown or so in terms of the price. The number of participants in the market, decreased by almost 50%. So between, at its higher points, 40% all the way down to 50%. But in this cycle, we haven't seen anything on that type of magnitude. We've, our drawdown, even in these more acute phases of the market, was at worst 30%. And we've been pretty consistently well above that, anywhere between around 15% to, 20, 22, 23% drawdown. So the number of active users has remained high. And we've shown that the number of active users is directly related to the price. So why then has the price seen such a massive correction if there's so many people still participating in the network? And that comes down to a lot of the, more systemic risks in the market that we've seen occur this cycle that we didn't necessarily see last cycle. So we're talking about things like forced liquidations of the Luna Foundation Guard, things like Celsius, things like Three Arrows Capital. Those have created immense sell pressure in this cycle, and you just didn't have that type of thing back here in the 2018 cycle. In addition to that, we've had economic concerns during this cycle that you haven't seen in the past. So you have had panic selling, certainly, but a lot of the sell pressure has come from these more institutional investors that we for quite some time hypothesized would actually sort of support the price of Bitcoin. But we've actually seen quite the alternative case where these actors in the market have actually caused a good portion of the price correction. And so when we come back to this chart then, we can see that based on the number of active addresses, we know it's continuing to grow, and we know that we've sort of stabilized in the, in the face of this massive correction that we've seen. We still see, in relative terms, the active addresses remain rather high. Certainly much higher than we would have expected if you were only looking back at the last market cycle. I think you're continuing to see increased participation in the network, and that is ultimately, as we've empirically shown now, going on 12 years, as we've literally shown for 12 years now that the number of active addresses participating in the network is related to the price in the long term. On shorter term timeframes, you can have spikes, peaks, or troughs of either price or active address, but in reality, these have no bearing on the price in the long term. The price in the long term has in fact been trending right along this line, with about half of the time spent below this line and about half of the time spent above this line. So when you have a long-term perspective on the market, it really helps you to eliminate the noise, and it really helps you to appreciate what's actually going on here. And what's actually going on, and all of this is open for debate, and if you have a different perspective, I'd be glad to hear it. But what's actually going on from my perspective is that, we're continuing to see high rates of utilization of the Bitcoin network. And in the short term, sure, certainly that can lead to the price bottoming out like we're seeing right now at 17, 18, 19, 20K. And it can even go lower from here. It could even potentially do it for a sustained period of time. However, when you have a long-term time perspective, and if you believe that for some reason this isn't going to drop off a cliff and we're going to head down to much lower utilization levels, then you have to believe, based on 12 years of data, that everything that we're seeing suggests that this is the growth trend that we're on. Okay, so I know this is a lot to unpack. I know there's a lot of information here. But I'd love to hear your guys' comments on this matter. I think there's a lot of things to consider here, and there's a lot of factors at play. So that's going to be it for this one, guys. Until next time, as usual, see you.